Welcome, everyone, to this quarter's strategic update. Our objective today is to lay out a really clear, data-driven case for allocating to Bitcoin in high net worth portfolios as we look out towards 2026. We're going to break down the massive shifts we're seeing in this asset class and show you exactly why the old models, well, they just don't apply anymore. Here's how we're going to break it down. We'll move through 6 key areas. First, we'll explain why the old market structure is a thing of the past. Then, we'll dive into the huge catalyst driving this new era. We're talking institutional demand and major macroeconomic forces. And finally, we're going to pull it all together to show you our strategic price target and exactly how we got there. Let's dive in. All right, let's jump right into the deep end. Before we can build the case for the future, we have to tear down the past. I'm talking about the framework that so many of your clients, and let's be honest, a lot of analysts are still clinging to. That predictable 4-year cycle, all tied to the halving. That model is officially broken. And that brings us to really the most important question in this entire space right now. The launch of the spot Bitcoin ETFs, led by the biggest asset managers on the planet, wasn't just some new product hitting the market. We have to ask the question, did this event permanently alter the DNA of this market? Our analysis points to a very clear, very loud yes. So this is the core of the shift right here. You see, the old market was all about retail excitement. It was driven by these wild, speculative bursts that were tied to the halving events, and it created these insane boom and bust cycles. Well, we've moved into a totally new regime now. This one is defined by steady, relentless institutional accumulation. The story is no longer about the supply schedule. It's about overwhelming demand and how it connects to global money flow. And the result? We're seeing less extreme volatility and a structural move towards a more stable upward trajectory. And look, the data, it doesn't just suggest this, it screams it. In every single previous cycle, Bitcoin only hit a new all-time high after the halving. This time, we blew right past that record before it even happened. That was the market's way of telling us loud and clear that the game has fundamentally changed. The new supply from mining is now just a drop in the bucket compared to the tidal wave of institutional demand. This isn't some small change, it's a complete structural break from the past. Okay, so this leads us directly to the primary catalyst for our entire thesis. What we're witnessing is a structural, profound, and what we believe to be a permanent supply shock, engineered by the biggest names in finance. First, and this is critical for your client conversations, we have to frame the spot ETF correctly. This is not a crypto product. It is a traditional finance vehicle, a simple wrapper that lets investors get exposure using the same brokerage accounts they've had for decades. This single distinction is what unlocked the trillions of dollars of capital that were sitting on the sidelines walled off from this asset class. The sheer scale of the initial demand was, frankly, staggering. I mean, $1.7 billion in just 3 days. That's not retail money. That is the sound of institutional floodgates beginning to open, and it signals a permanent change in how this asset is accessed and valued. This chart right here, this is probably the most powerful slide in the entire briefing. It's so simple. On the left, you have the new Bitcoin being created each day, around 900 coins. And on the right, you have the daily demand from just the ETFs, which has been consistently sucking up 10 times that amount. It's a basic supply and demand problem, and the imbalance is just massive and ongoing. And get this, it's not even evenly spread out. The accumulation is incredibly concentrated. BlackRock's IBIT fund, just one product from one company, has shown it can, all by itself, absorb more than the entire new daily supply of Bitcoin. This tells you everything you need to know about the conviction coming from the world's most powerful asset manager and their clients. This quote just captures the dynamic perfectly. A black hole is a one-way street, and that's exactly what these ETFs have become for Bitcoin. The coins they buy are being pulled off the market and locked away in institutional-grade cold storage. It's a one-way flow of a very scarce asset onto Wall Street's balance sheets. Okay, so we've talked about the ETFs, but the institutional story doesn't stop there, not by a long shot. An even deeper shift is happening at the corporate level, and a very clear blueprint is starting to emerge for everyone to follow. MicroStrategy, under Michael Saylor's leadership, has essentially written the corporate playbook. By systematically swapping their cash reserves for Bitcoin, and they've now stacked over 761,000 of them, they've effectively become the asset's central bank. But more importantly, they've created this very public, very successful case study for every other boardroom on how to protect their treasury from the silent tax of inflation. Their actions are signaling what you could call a smart money panic, a race to grab a piece of this neutral reserve asset before everyone else does. This is the slide you show your clients who own businesses. It frames the choice so clearly. With a traditional strategy, you're holding cash that is guaranteed to lose purchasing power over time. You're getting a negative real yield. The Bitcoin strategy, on the other hand, positions the company's balance sheet to actually benefit from that same monetary expansion. It turns the treasury from a sleepy cost center into a potential engine for growth. And here's the real kicker. This isn't a niche strategy anymore. The plumbing is now being connected to the largest pools of capital on Earth. When the big wirehouses, your Morgan Stanleys, your Wells Fargos, your Merrill Lynches, start greenlighting these products for their massive advisor networks, they are unlocking access for literally trillions of dollars in assets. This is the next giant wave of capital. Now, all of this incredible institutional demand isn't happening in a vacuum. It's actually being supercharged by some very powerful global macro forces. Think of the macro environment as a massive tailwind pushing this whole thing forward. So if you look at where interest rates are projected to go, the consensus is pretty clear. We're basically at the peak. Central banks are going to have to start cutting rates to spur growth, likely by 2026. As rates fall, the opportunity cost of holding a non-yielding asset like Bitcoin plummets. Simply put, when boring old bonds pay less, Bitcoin starts to look a whole lot more attractive. But the number one driver, the biggest piece of the pie here, is the expansion of the global money supply. You can just think of it as more cash sloshing around the system. Well, when more money is created, hard assets with a fixed supply are usually the biggest winners. And as central banks continue to print to manage debt, that new liquidity has to flow somewhere. Scarce digital assets are often the first place it shows up. And for clients who are worried about growing global instability, this is a key part of the conversation. In a world that feels more and more fractured, Bitcoin acts as a neutral, non-sovereign asset. You can hold it yourself, you can move it across a border without asking for permission, and unlike traditional assets, it's incredibly difficult to seize or block. It's a form of financial insurance, and that's why we're even seeing nations start to think about it for their own reserves. And finally, from a risk perspective, the single biggest hurdle for institutional adoption, regulatory uncertainty, is finally starting to fade. You've got the MiCA framework in Europe providing a clear rulebook, and you've got serious bipartisan bills moving forward in the US. This is a massive de-risking event. It's the green light that the big conservative pools of capital have been waiting for. Okay, just a quick pause here. If this analysis is proving valuable for your practice and for your client conversations, please take just a second to like this briefing and subscribe. It really helps us continue to produce this level of research, and it guarantees you won't miss our future updates. So we've got the demand story and the macro story. They're powerful, but it gets even better when you look under the hood at the asset itself. The on-chain data is showing us a fundamental maturation in who is holding Bitcoin and how they're behaving. Now, this is really fascinating. What we're seeing is a huge shift in the type of owner. The old market was all retail, folks who are more likely to sell when things got choppy. The new market? It's increasingly dominated by institutions making long-term strategic allocations. Their conviction level is just off the charts, which means less panic selling and more price stability. We're seeing a massive transfer from what we'd call weak hands to strong hands. And this data point right here proves it. A whopping 60% of all Bitcoin hasn't moved in over a year. That is a powerful indicator of long-term holding. What that means is the amount of Bitcoin actually available for sale on the open market, the float, is at an all-time low. This incredible scarcity on the supply side just acts as a massive amplifier for the institutional demand shock we've been talking about. And when you put all this together, you can see the effect on the asset's behavior. Yes, it's still volatile, but we're seeing significant volatility compression. The big crashes are becoming less severe. This is absolutely crucial for you when you're building portfolios because it improves the asset's risk-adjusted returns, making it much easier to justify a small allocation. And this quote just puts the potential scale of this thing into perspective. More and more Bitcoin is being seen as digital gold, while the global gold market is worth over $12 trillion. We're not talking about replacing it overnight. A tiny 0.5% reallocation from gold to Bitcoin would be a tidal wave of capital unlike anything we've seen before. The thesis that digital scarcity is winning is gaining some serious momentum. Okay, so let's tie it all together. The death of the old cycle, the institutional supply shock, the corporate playbook, the macro tailwinds, and this maturing investor base. Let's put all the pieces together and outline the path to our 2026 strategic price target of $150,000. We see this playing out in three distinct stages. Stage one is the technical breakout. We need to decisively shatter that previous all-time high resistance, which we see around 126,000. That breakout triggers stage two, institutional FOMO, the fear of missing out. Suddenly, the career risk for a portfolio manager isn't owning Bitcoin, it's not owning it. That creates a snowball effect of new allocations, which leads to the final stage, the run toward our target, as global liquidity conditions peak. And our quantitative models, which weigh all of these different factors, are now assigning a 70% probability that we'll break that previous high and enter a sustained price discovery phase within our 2026 window. The odds are now heavily stacked in favor of another major upward cycle. This right here is the central question for your client conversations now. The entire paradigm has shifted. For the last 10 years, the risk was owning Bitcoin. In this new world of institutional adoption and endless money printing, the far, far greater risk is having a 0% allocation and having to explain to your clients why they missed out. So the crucial takeaway we want to leave you with is this. The debate over if you should allocate is over. The data now makes it clear the question has to be how to allocate. A strategic, right-sized position is becoming an essential part of any diversified, forward-looking portfolio. But before you go, a quick look ahead. Our next strategic briefing is going to shift focus to the number 2 digital asset, Ethereum. We're going to dive into the institutional case there, talk about its layer 2 ecosystem, and the potential for what some are calling an institutional flippening. So if you want to stay ahead of the market, make sure you're subscribed and have those notifications turned on. All right, as always, this has been an educational overview based on our market analysis. It is not financial advice. Please conduct your own due diligence for all investment decisions. Thanks for your time, and we will see you in the next briefing.